In the early days of crypto, passive income often meant staking tokens, joining liquidity pools, or lending assets through decentralized finance platforms. For a while, these methods looked promising. Some platforms offered extremely high returns, and it felt like earning money was as simple as holding the right coins. But as time went on, the risks became more obvious. Many of those high-yield opportunities were built on unstable foundations. Protocols failed, token prices collapsed, and many investors lost money. What was once considered passive income turned out to be highly speculative. Now in 2025, the crypto space is changing in a more mature and sustainable direction. One of the biggest developments is the rise of real-world asset tokenization. This means taking traditional financial assets like U.S. government bonds, real estate, or private loans and turning them into digital tokens that can be used on the blockchain. This shift isn't just coming from startups or small projects. Major institutions like BlackRock, J.P. Morgan, and Franklin Templeton are already issuing tokenized funds on public blockchains. These are assets backed by real-world value, and they're beginning to play a key role in the crypto economy. For everyday investors, this means a new way to earn passive income. Instead of depending on risky or highly volatile tokens, it's now possible to earn steady returns from assets like tokenized treasury bills or business loans, all without leaving the crypto ecosystem. In this video, we'll explore exactly how that works. We'll look at the top platforms offering these opportunities, explain how the yields are generated, walk through how to get started, and break down the risks to watch out for. By the end, you'll have a clear understanding of how crypto is creating new, more reliable ways to earn real passive income using real-world assets. Let's get started. Now that we've talked about how crypto is shifting toward real-world value, let's focus on what most people are really interested in: how to actually earn passive income from these tokenized assets. Several platforms are already live and offering real opportunities to earn income from tokenized assets like government bonds, business loans, and even real estate. These platforms are helping to build a bridge between traditional finance and blockchain technology. Let's go through some of the top options that are currently active and worth watching in 2025. First one is Centrifuge. Centrifuge is one of the most established platforms in the real-world asset space. It connects traditional businesses looking for financing with crypto investors who want to earn income from real-world loans. Here's how it works. A business might need funding based on assets like unpaid invoices or real estate. That loan gets tokenized and placed into a lending pool on Centrifuge. Investors can contribute stable coins like DAI or USDC into the pool. In return, they earn yield, usually in the range of 6 to 10% per year. The income comes from interest paid by real-world borrowers. It's not based on speculation or token price swings. Centrifuge has also been integrated with MakerDAO, which uses these assets to help back the DAI stablecoin, adding further liquidity and utility to the ecosystem. Second one is Ondo Finance. If you're looking for a lower-risk option, Ondo Finance is one of the best choices. It offers tokenized U.S. treasuries, allowing stablecoin holders to earn returns from the most secure government-backed bonds in the world. The main product is called OUSG. It's a token that represents shares in a fund backed by short-term treasury bills. The yield usually tracks the real-world bond market, and as of 2025, it's typically around 4 to 5% per year. You can purchase OUSG using stablecoins and hold it in your crypto wallet, just like any other token. It's a simple and stable way to earn yield, especially for people who want to reduce exposure to volatility while still staying in the crypto ecosystem. Third one, Goldfinch. Goldfinch focuses on providing loans to businesses in emerging markets. These are typically small and medium-sized companies that can't easily access traditional financing. By participating in these lending pools, crypto users can earn returns while also supporting global economic development. Yields on Goldfinch can range from 8 to 15%, depending on the type of loan and the region involved. Since these loans carry higher credit risk, they come with higher potential returns, but also more uncertainty. Goldfinch uses a system of local lending partners who handle borrower selection and credit checks. For investors with a moderate to high-risk appetite, this platform offers a unique way to diversify and potentially earn more than on safer platforms. Fourth one, Maple Finance. Maple is a decentralized credit protocol that originally focused on lending to institutional players within the crypto space. These include trading firms and other blockchain-native companies. In recent years, Maple has expanded its reach to include real-world asset lending as well. Investors can contribute to lending pools and earn returns typically between 6 and 10%. Maple performs due diligence on borrowers, but many of the loans are under-collateralized, meaning they are not fully backed by assets. This creates higher risk, but also allows for potentially higher yields. If you want exposure to more advanced credit markets and you are comfortable analyzing lending risks, Maple can be a strong addition to your passive income strategy. And the fifth one is MakerDAO and the DI savings rate. MakerDAO is the decentralized organization behind the DI stablecoin. In recent years, it has begun backing part of its reserves with real-world assets, such as government bonds and commercial loans. This has allowed MakerDAO to offer something called the DI savings rate, or DSR. Anyone who holds DI can lock it in the DSR contract and earn passive income. The rate has varied over time, but generally sits between 3 and 5% as of 2025. Because the DAI in the system is backed by both crypto and real-world assets, this savings rate is becoming a more stable and attractive option for users who want yield without leaving the decentralized ecosystem. These 5 platforms represent some of the most active and credible ways to earn passive income from real-world assets today. Some, like Ondo Finance, focus on safety and predictability. Others, like Goldfinch, are designed for higher risk and higher reward. Platforms like Centrifuge and MakerDAO offer a middle ground with balanced exposure to real-world value and on-chain usability. Now that we've looked at some of the top platforms in the real-world asset space, let's dig into the most important question. Where do these yields actually come from? This is where things really start to set RWA income apart from the older DeFi models. In the past, a lot of the passive income in crypto was built on token emissions, high-risk leverage, or circular incentives. You would earn yield not because the protocol was generating real value, but because it was giving out more of its own token to attract users. That approach worked for a while, but it wasn't sustainable. With real-world assets, the story is very different. These yields come from off-chain, real-world activity. When you invest in an RWA-backed protocol, your funds are often being lent to a business, placed into a bond fund, or allocated toward some kind of income-producing activity that exists outside of crypto. Let's go over a few examples to understand this more clearly. Example 1. Tokenized treasury bonds. Take Ondo Finance, for example. When you buy a token like OUSG, you are effectively investing in a fund that holds short-term U.S. Treasury bonds. These bonds pay interest to the fund. That interest is then passed on to token holders. You're not earning yield from crypto speculation or hype. You're earning it from the U.S. government paying interest on its debt. That interest rate will change depending on macroeconomic factors like inflation, central bank policy, and bond demand. But the source of the yield is clear and based on traditional finance fundamentals. Example 2. Real-world lending. Now, take a platform like Centrifuge. When you contribute funds to a pool, those funds are lent to a real company. That company pays interest on the loan just like it would if it borrowed money from a bank. The interest goes into the pool and it's distributed to investors. What makes this different from centralized lending is that the process is handled through smart contracts. The assets are represented on-chain and the payments are tracked in a transparent, verifiable way. But the source of the return is still a business activity, like selling goods or services, not just moving money around in the crypto space. Example 3. Loans in emerging markets. With a project like Goldfinch, you're helping provide credit to borrowers in developing countries. That could be anything from a farming cooperative to a small tech company. Those businesses use the loans to grow, and they repay them with interest. The platform takes a portion to cover risk and operations, and the rest goes to investors. Because these are often in markets with limited access to capital, the interest rates can be relatively high. This creates an opportunity to earn more, but also introduces higher risk, since the local economies can be unstable and legal enforcement may be more complex. So, to sum it up, the yield you earn in the RWA space comes from the same basic place it does in traditional finance. It comes from lending money, buying bonds, or financing productive activity. The key difference is that everything is done through blockchain systems, which brings more transparency, faster settlement, and often lower overhead costs. It's important to understand that while the yields in RWA protocols can be more stable and based on real income, they are not risk-free. Things like borrower defaults, market conditions, and regulatory issues can still impact performance. But compared to the high-risk yield farming of early DeFi, real-world asset yields tend to be more grounded, more predictable, and more sustainable over time. Let's go over how to actually start earning yield from real-world assets using your crypto wallet and stablecoins. Here's a streamlined, step-by-step process. Step 1. Set up your wallet and fund it. Use a wallet like MetaMask, Rabby, or Coinbase Wallet to interact with RWA platforms. Once installed, store your seed phrase safely. Fund the wallet with stablecoins like USDC or DAI on the correct network, usually Ethereum or a compatible chain like Polygon. Step 2. Pick a platform based on your goals. Choose a platform that fits your risk tolerance. Some focus on stability, offering steady yields from tokenized government bonds. Others target higher returns through lending to private businesses or emerging markets. Explore their features and look at past performance. Step 3. Complete KYC if required. Depending on the platform and the assets involved, you may need to verify your identity. This usually takes a few minutes. Fully decentralized options also exist where no KYC is needed. Step 4. Deposit and start earning. Deposit your stablecoins into a chosen pool or vault. From there, yield generation is typically automatic. Some platforms may have lockup periods, while others allow more flexibility. Step 5. Monitor and manage. Track your returns through platform dashboards. Consider diversifying across multiple pools to reduce risk. And keep in mind that income may be subject to tax depending on your location. That's the basic process. The actual steps are quick, and the complexity stays mostly under the hood. If you're holding stablecoins like USDC, there's a simple way to start earning yield without managing complex DeFi positions. Some newer platforms now offer stablecoin-based returns that are backed by real-world assets like treasury bonds or credit markets. These protocols handle the complexity in the background. You just convert your stablecoins into their native tokens, and the yield is built in. No need for staking or active management. Let's look at a few examples. Example 1. Mountain Protocol. Mountain Protocol offers USDM, a stablecoin backed by short-term U.S. Treasury bills. When you hold USDM, it automatically earns interest because the underlying assets generate yield. You simply swap USDC for USDM and hold it. No lockups, no extra steps. It works like any stablecoin but grows in value over time. Example 2. Reserve Protocol. Reserve offers RSV, a stablecoin backed by a basket of tokenized government securities and other stable assets. By holding RSV or participating in its minting, users share in the yield from those assets. The protocol focuses on diversification and stability, making it an attractive option for passive income with less volatility. Example 3. Superstate and similar tokenized funds. Some platforms, like Superstate, are tokenizing traditional funds, giving stablecoin holders access to regulated financial products. These often require KYC or accredited status, but they offer clear, predictable returns directly linked to Treasury yields. It's a more formal bridge between crypto and traditional finance. These stablecoin strategies are among the easiest ways to earn yield from real-world assets. There's no need to analyze individual loan pools or manage ongoing positions. Just convert, hold, and let the platform handle the rest. While real-world assets bring more stability than most DeFi strategies, they still come with their own set of risks. Understanding these can help you make smarter, safer decisions. The first important risk to consider is counterparty risk. Most RWA platforms lend money to real-world businesses or institutions. If one of these borrowers fails to repay, your returns could be delayed or even lost. Some protocols try to manage this by requiring collateral or offering insurance, but no system is perfect. That's why it's important to look into how each platform selects and monitors its borrowers. Next comes regulatory uncertainty. Since real-world assets fall under traditional financial laws, some platforms may require identity verification or limit access based on your location. Regulations are still evolving, and they can change quickly. This could affect whether you're able to use a service or even freeze access to certain features. Always make sure the platform you're using complies with the laws in your country. Another key factor is smart contract risk. Even though these protocols connect to real-world assets, they still run on blockchain technology. That means smart contract bugs or vulnerabilities can still put your funds at risk. Choosing platforms that are well audited and transparent about their code is one way to reduce your exposure. Then there's the issue of liquidity. Some RWA investments lock your funds for fixed periods, sometimes 30, 60, or even 90 days. That means you may not be able to withdraw your funds when you want to. If flexibility is important to you, look for protocols that offer liquid staking, secondary markets, or shorter lockup times. Another consideration is exposure to traditional market risks. Since these assets are tied to real-world systems, they're also affected by things like changes in interest rates, currency fluctuations, or political instability in the countries where borrowers operate. These are common risks in traditional finance, but they now play a role in on-chain investments as well. Lastly, there's the reality of fluctuating yields. Even though these returns are grounded in real-world value, they're not fixed. A treasury-backed protocol offering 6% today might drop to 4% next month. That's normal in any market environment. So it's good to monitor your investments and avoid chasing the highest numbers without understanding the risk behind them. To stay safe, consider spreading your capital across multiple platforms or asset types. Pay attention to reporting, transparency, and borrower performance. And don't forget about taxes. In many places, income earned through these platforms is taxable, so it's smart to track everything properly or use a crypto tax tool. The key takeaway is that while RWA platforms offer a more stable way to earn yield, they're still investments. Being aware of the risks helps you avoid surprises and take full advantage of this growing part of the crypto ecosystem. We've covered a lot in this video. From the basics of real-world asset tokenization to the platforms generating yield, how to get started, and the risks to be aware of. By now, you should have a clear picture of how crypto is evolving from speculative hype into a more grounded and useful financial system. Real-world assets bring something important to the crypto space: stability, long-term value, and real economic activity. Instead of chasing short-term price swings or relying on unsustainable reward models, users now have the option to earn passive income from government bonds, business lending, and real estate, all while staying within the crypto ecosystem. This shift is more than just a passing trend. Major institutions like BlackRock and Franklin Templeton are already building solutions in this area. Regulators are starting to pay closer attention, and more users are realizing that crypto-based income does not have to involve high levels of risk. As this space continues to grow, we are likely to see even more assets come on-chain. That could include stocks, commodities, or full portfolios of income-generating products. We can also expect smoother user experiences, faster settlement times, and easier access through familiar wallets and platforms. In the near future, earning 4 or 5% on your stablecoins might be as simple as holding them in your wallet. Lending to a small business anywhere in the world might be just a few clicks away, with full transparency and built-in protections. Whether you are just starting out or already active in the crypto world, real-world assets represent one of the clearest and most practical opportunities in 2025 and beyond. Thanks for watching. If you found this useful, consider exploring one of the platforms we discussed, and don't forget to like the video and subscribe for more content on the future of crypto and finance.